Bloomberg News.
Bob Prechter is the CEO of Elliott Wave International. He joins us from Atlanta, Georgia. Bob Prechter, welcome back.
Yeah, thanks for having me again.
Bob, I know one day does not make a trend, but does today's market action give you any pause as to your overall thesis of market declines?
Oh, we could talk about this from many angles. For one thing, the last time I had to look it up to find out when the last time we spoke was, and it was the 20th of August. That's more than 2 months. It's been a very exciting couple of months. The Dow fell 3,000 points, S&P 400. And one reason I wanted to wait till late October to talk to you again is usually that's when the seasonal period of September and October is pretty much out of the way. So we had a very clear bearish pattern in August, and so we got some pretty good results out of that. Now the question is, what's going on short-term and long-term? To answer your question, we went back and did a study going back 100 years to find out when the biggest days up and down were in terms of percentages. So we wanted to see, are there any clusters historically? Do they come at random places or specific ones? We found that by far most of the biggest up and down days, and actually more of the biggest up days than the biggest down days, occurred in the largest bear market we've ever had, which was 1929 to 1932. And according to our Elliott Wave interpretations, that's the kind of thing we started last year. So we're not surprised now that we've seen, I believe this is the fourth day that is in the Hall of Fame for being in the top 20 days, either up or down, of the last 100 years. So I think we are in that kind of market where you're going to see a lot of volatility. Big up days and down days per se don't mean very much for the short term, but they do indicate what's going on long term, and that is we're in a bear market which tends to be very, very volatile, especially in the rallies, and we saw that today.
Bob, one of the things I think you've noted about this particular bear market is you say this portends something quite unusual, something we have not seen in quite a long time, and that is asset price deflation. Are you still, do you still support that theory?
Well, it was touch and go there for a while in '07 and early '08, but we finally saw the peaks in virtually every major commodity, certainly all the commodities that were leading the charge on the upside. And we have had tremendous promises of inflation and guarantees of inflation from the Federal Reserve, from the Treasury Department, and from Congress since then. And yet stocks have gone down, commodities have gone down, precious metals have gone down, platinum and silver are down almost 60%. Those are huge drops in a matter of months. So I think this whole scenario we've been looking for is coming to pass. It started with real estate a couple of years ago and has finally made its way to the commodity markets.
Bob, is there anything that would give you pause about this? Would be any government action that could change your opinion?
No, I don't think there will be. But what is kind of interesting is another study we did showing in the past 2 months, during September and October, there have been as many gap up, excited up days as there have been down days in the market, and virtually every one of those occurred on one of these announcements, whether it's a Fed lowering the interest rates or the Treasury coming out and guaranteeing, to hold a company together like Fannie Mae, Freddie Mac, or AIG. Buying stock in the banks. All of these announcements have created these very, very sharp short-term rallies. And of course, we're on the cusp of another one as we speak because of the Fed meeting tomorrow.
Bob, if you predict deflation, you've talked about that for some time. If that's the case, what are some of the recommendations you would make to individual investors? What should they do with their money if indeed they agree and see deflation ahead?
Well, the main recommendation I made was to get out of all traditional investments, real estate, stocks, most corporate bonds, mortgages, commodities, because what you really want to hold in a deflation is cash and safe cash equivalents. Now, in the old days, that used to be pretty easy. You just bought a treasury bill or, held some cash and that was fine. But in these very, very unusual days where we've had such a credit balloon, it's tough to do. So I outlined, things to avoid. You don't want to just put money in a bank account. Some banks are going to close, and you might have to wait for the FDIC to come in. And if there's a systemic problem, that could be even more difficult. So you want to pick certain banks that tend to be safer than others. I think it's a good idea to be diversified across several different currencies from more, let's say, trustworthy governments that aren't quite the spenders that we are. So I've developed something called the stable currency benchmark, and we've done many permutations. But the one word is cash, and that's been great lately. You know, it's yielded ever since 2000 enough to be up total about 30%, while the S&P has lost 26%, and that's even including the dividend. So there's S&P would really have to double to catch up with someone who bought T-bills in 2000.
Bob, let me just bring your attention to some news crossing the Bloomberg terminal right now, this having to do with General Motors GMAC, which is their finance arm, saying that the Federal Reserve has granted their request to participate in the commercial paper program that the Federal Reserve has put together, giving GMAC access to that commercial paper. If indeed, Bob, we're going to see more types of action along these lines, why shouldn't investors try to take advantage of that opportunity? Is it because you feel that there's no way to predict it, it's arbitrary, or why wouldn't you want to take advantage of the federal government's participation?
Well, if I were General Motors, I certainly would. But in terms of stock market trading, we have been taking advantage of every one of these very sharp rallies. We say, look, there are rallies in a bear market. If you're still stuck in some stocks, it's a great opportunity to use the rallies to get out. But here's another interesting thing that's going on. We talked about people buying on these news items, and this news item is probably going to contribute, along with the Fed tomorrow, probably lowering interest rates. So just as all the other rallies in the last 8 weeks, you'll probably see a very powerful jump and an extreme gap on the opening, that sort of thing. They're very exciting rallies. It's all part of what's going on. But what we also looked into very carefully was what's happening in terms of the daily volume, because we've read a lot of commentary from people who said, oh, everybody's panicking, so it's a bottom. Now, granted, I think we've had a short-term low. We got through the seasonal period. We've had a divergence between the Dow and the transports. We've had a drop in volume coming into this bottom. So we're ready for a rally here, and that's what we've been talking about. But is it a new bull market? Well, those daily moves on the upside have tended to be the ones that attracted the big volume days. Now, in every panic that we've studied in the past, whether it's 1929, 1987, or 1962, you tend to see a growing volume as the market goes down, and we've seen the opposite. Down days have light volume, and all the excited news events bring in the volume on the upside. So from our point of view, we really have not seen any panic yet. One reason I didn't bring any charts today is the charts I wanted to show have so much detail you really can't see them. So if any of your viewers are interested, we've posted them for free on a website. It's just elliottwave.com/charts if they want to take a look at what we're talking about.
Bob, just to kind of give some context, if we go back to October the 10th, which was a significant low, we're looking at almost 3 billion shares trading hands on the NYSE. Today, 1.7 billion. So your point is well taken, comparing a volume. Let me just ask you, though, about gold, about some precious commodities. Is that an area to go to if deflation is going to rear its ugly head?
Commodities, you don't want to be in commodities or the precious metals during a deflation. But I have said many times that one of the exceptions is gold. I don't think gold is going to have nearly the decline of the commodities. It may hold up quite well, and one reason is that it's actual money. And I think people have changed. What they wanted from 2000 all the way up to 2007 was debt. You know, give me some more of that great, wonderful IOU packages that I can invest in. And what they're after now is cash. And that means, you know, short-term T-bills, it means cash, it means gold, it means some of the short-term bonds from Switzerland or Singapore or New Zealand.
We're at it. We have short-term time at the moment. Bob Prechter, thank you very much for joining us.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2008.